Today I have the great pleasure of welcoming you to our discussion on Canadian proposals for a central bank digital currency and introducing today's speakers. The Bank of Canada engaged 3 independent project teams to conduct exploratory design work for a digital currency that, like a traditional banknote, would be widely accessible, secure, and denominated in Canadian dollars. Today, we have expert researchers who have come together to discuss their design proposals and debate the risks and benefits of each proposal.
Tell a few words about our proposal from McGill. So many central banks are considering issuing cash-like central bank digital currencies, and that, of course, includes Bank of Canada. And for their priorities are safety, universal accessibility, privacy, resilience, competition and efficiency, and monetary sovereignty. And from these aspects, we particularly focused on the question of privacy, as well as at the same time enabling compliance with the regulation, most notably with anti-money laundering. And I have two of these kind of opposite examples. One is called token money. So a good example of this is any physical cash. And the good point about token money is that it is good for privacy in a sense that there is no involuntary data collection. So the idea of token money is that the banknote itself is verifiable, but we don't need to trace like who sent it and who received it. Now, account-based money in terms of the privacy, it is opposite, because here we are verifying who sends it and to whom, and we argue, and we have a model in the paper as well, that this data collection on individual purchases could have adverse effects. Now, on the other hand, the weakness of token money is that it's harder to ensure compliance, and it's kind of defeating the purpose of having a digital currency, because we would want to build something on this digital currency, perhaps like smart contracts and things like that. And what we argue is that it should resemble both, but in a very particular way. So what we are proposing is a central bank digital currency design with intentional asymmetry, which aims to keep money spent maximally private, while there is limited privacy of money received, of course, by those who need to know. So in our system, there are two sorts of accounts. So to access the system, Bob and Alice. So Alice is a consumer here. Bob has a cafe which sells coffee to Alice. And then Alice has put some funds to her ID-linked account. And now, in order to make it private and before spending, Alice is going to turn some of her funds into digital private coins, which are anonymized. These private coins will then be a little bit like a banknote, in a sense that when Alice goes and spends it in the Bob's Cafe, what we will record is that Bob has received the funds, but this transfer is no longer associated with Alice, which is unlike the account-based money. These were the main goals for the system architecture. Tools to implement it is for privacy, proposing the use of zero-knowledge proofs. For compliance, this is a whole idea of ID-linked accounts with transfers between private coins disallowed. And for transparency, we propose to have this system to be blockchain-based, but because it is a centrally managed digital currency anyways, and we are proposing to use proof of authority rather than the costlier means.
First kind of question we try to address is, where does the value come from? So this whole developing this infrastructure will cost a lot of money, a lot of investment required by the private sector, so there has to be a pie. And we think that the big value improvement, the big value creation of CDBC comes from smart contracts. It also allows us to create a lot of innovative products that don't exist today. So if you think about, for example, a real estate transaction where the purchase price is held by a lawyer in escrow, and while this doesn't happen very often, it has happened before that the lawyer vanished with the money. So we could lock up that purchase price, purchase amount in a smart contract and transfer the purchase amount to the seller once the land title has been transferred. Other big economic question we want to address is the incentives to adopt. So we think that it's really important to bring the existing financial intermediaries, the banks, the credit unions, the insurance companies on board to be. So why is that a potential problem? Because CBDC could lead to disintermediation. So when people hold their savings not with the central bank, instead of bank deposits, we can think about that in the world today as if everybody would hold all their savings in cash in a safe. Then the banks don't have any money, and the banks cannot give out loans to the economy, and loans are important for businesses to grow the economy. Two realms in our proposal. So one is the banking plus realm, which is account-based and follows the KYC rules for anti-money laundering and anti-terrorism financing. This is run on a distributed ledger system with strong privacy by default. And this is where you have a menu of smart contracts. We can think about that like an app store where the smart contract comes from the bank that you're banking with. On the other hand, we have the Cash Plus realm, where people can withdraw tokens from their Banking Plus account. And this is totally anonymous. And more importantly, it also allows offline payments. To summarize, I think that digital currencies are inevitable. If we as Canadians want to realize some of these economic efficiencies and preserve Canada's monetary sovereignty, we need to do something and invest in a central bank digital currencies.
The way we propose it, and this is, for instance, where we deviate, for instance, from what Alfred says, is we believe that it is important that you have a two-step process to do this. In the first step, we believe that the Bank of Canada should go ahead and establish CBDL or CBDC by itself on a permissioned system, on a centralized system, so that you establish the digital money. And then in the second phase, you would invite the public sector, including the banks, but also other payments processors, maybe the telcos, to also participate in a larger network, which would be a blockchain type network. It's a permission network, which would then be a shared infrastructure, if you want. In February last year, issued a contingency plan where they said we will issue or will consider issuing a CBDC if cash becomes no longer usable, which is really still a very important tool for many Canadians, and or if an alternative digital money starts taking over. Criteria, the ones that we felt were important to cover and to think through, is the question of onboarding and KYC. The processing, of course, but in particular how you can make it anti-money laundering, counter-terrorist financing compliant. Then what we wanted to have is we wanted to make sure that we propose a system that can be connected to the existing FIs. Features that we also wanted to think about is how can you have privacy protection, how can you make it such that you need only minimal interaction with customers because the Bank of Canada doesn't want to run a call center, and how you then have enabled innovation and competition in the payments market. Now, this transaction processor plays a major role in the way how we think about the system. We call it a narrow bank because for all practical purposes, it acts like a narrow bank. And the relation to the FIs would be such that this is basically a new public utility under the oversight of the Bank of Canada, which would process all CBDL transactions in the first phase. It would be linked to the normal payments network, so that if you want to use it, you may just make an electronic fund transfer from your commercial bank account into the account, if you want, that you have, which would be a wallet at the transactions processor. Now, quickly, how would the CBDL transfer actually work? You go to a merchant, let's say. The merchant gives you a set of instructions that could be just a QR code that you scan with your phone. You then digitally sign it and send it to the transactions processor. The transactions processor will check first your signature. It's a digital signature. As we know, this works extremely well in terms of being secure. You would check whether or not the recipient and the sender are both on the whitelist of authorized users. And then, of course, whether or not you have the right balance. A digital currency, not just as money, because that's really boring and it's not really the point, right? But you should see it as a common infrastructure, common resource, which would be there actually for a variety of service providers, which could have programmable features so that Canadians actually can do some innovation and provide new products and new ideas, and also at the same time have high privacy protection.
How far do you see smart contracts go in the future?
We see that at the moment in the decentralized finance space, in the Ethereum space, there's a lot of smart contracts being developed that do little things. We could see them as kind of little Lego bricks that do one particular problem, like swapping one token against another token. But those can be combined with other Lego bricks who do, for example, lending. And you can build these great smart contract applications using these little Lego bricks, combining them to achieve greater things. These smart contracts are programmable money that can do different things. So it's not just I pay you. I could pay you based on certain conditions. I can put some money safely away in an escrow account that get released under certain conditions. I can do a lot of use cases and build them as a smart contract where there is no problem of operational risk, of settlement failure.
Of that, do you see any, I guess, unintended consequences? So let me give an example. Government of Canada eventually giving social security payments where they put conditions that you can't spend it at the LCBO.
That could be one potential application. Whether this is whether it's good or bad that you spend your social security money in the liquor store or not is a different
it
question.
Could create a shadow economy where someone sells that off to someone else.
There could be a lot of unintended consequences, and if we want to look for unintended consequences, we just have to go and look at the Ethereum world today. This is, somebody recently published an article that Ethereum is a dark forest where there's a lot of predators waiting for you to make a mistake, and that is absolutely true. And so
I think the bigger concern is the transition and to get the financial sector on board and to work through the resistance that is coming. So if you look at what happened in the US, when they made the announcement about CBDC there, it just took us 2 days for JP Morgan and Goldman to ring the alarm bells about how they should not do this and how they should slow down.
Why do we even need a central bank digital currency? Everything's going online and cashless anyway.
The way the existing electronic system works still has a lot of inefficiencies. A lot of people look at trying to balance check Excel payments. So if one company owes some contractual obligations to another one, they make sure that they compute how much they owe the other company. The other company does the same computation again, looks at am I being paid the right amount? They make the payment, things could go wrong. So there's a lot of work involved in verifying that these contractual obligations are met, that the payments are correct and match these contractual obligations. So all of this could be automated with smart contracts, which cannot be done in the existing system. Payment system as it is could potentially be improved, but still lags behind a lot of the technological possibilities it still takes. If I want to send Andreas some money with the traditional financial system, it still usually takes a lot of time. If you use an e-transfer, it's fast, but it only goes for so many dollars. If you want to send a large amount, it doesn't work.
This is the most misunderstood issue. Yes, it's easy for you to tap your card and all that. That's fine, right? But the inefficiency in the system are massive. The cost of the system on Canadian consumers is massive. The payment sector has revenues in 2016, it's the latest data that I saw, of $16 billion. That's bigger than the agricultural sector. And that's just for shifting money around. This is not a competitive market. It's not a competitive sector. If you look at the efficiencies gained from WeChat Pay, for instance, in China, whatever you want to think about it, it's phenomenal what they have accomplished. Retail banks provide commoditized services first and foremost, yet they're big and expensive. So the efficiencies that are just driven just by the inefficiencies of the payment system are there. And the cost paid for the inefficiencies is actually by poor people. So the payment system as a whole, and if you look at the history of the whole thing, since basically since we had the low interest rate environment after the dot-com bubble burst, banks have shifted from making money of interest to making money from fees, right? Most of these come in some form or another from the payment system, and they come usually by exploiting the inefficiencies that are there, and they go at the expense of poor people. This is the most regressive system that exists.
Now, when countries move to central bank digital currencies, well, will cryptocurrencies still exist?
I think they will. I mean, people still buy gold as a store of value, even though we have Canadian dollars, and people might still want to buy Bitcoins, even if you have a CDBC, because they think they want to put some of their savings into this digital asset, and why not? The important part is that the government, if too much of the private sector investment moves to Bitcoins and things like that, or other stable coins that are being issued, there's a real threat. What if one of those systems fails? What if everybody uses Facebook's digital currency and then Facebook goes bankrupt?
Central bank's digital currencies are better for privacy, for spending. Like this is, because like people think Bitcoin is very private, but it's rather pseudonymous. So it is still, unless people make big efforts to lose a trace, like it is still like traceable what you spend compared to some things that can be generated more systematically.
What do you think the future looks like?
Every country will issue their central bank digital currency. We will move to a world where more of the trading goes to these smart contract platforms. We will have an app store where we can buy certain financial products that we can combine with money and use them from our phone. This will broaden the access for small corporations, access to finance. Financial markets will hopefully get more competitive, and consumers can benefit from that.
I guess that in the spirit of my proposal, I think there is increasing attention to the data privacy issues and more nuanced questions about what do we want to actually protect. And this is obviously like enhanced with better abilities of data analysis and the possibility to then build better things based on this data, which is relevant for many fintech developments. So this is two things, like more attention and thinking about that. And second, new financial products, like, individuals being able to participate as they are now in a greater set of financial assets and investments and better contracts. So
I agree with Alfred that many countries will be issuing a CBDC within the next 10 years. Smaller countries will adopt, the CBDC of larger countries, so they will actually no longer have monetary policy. The financial sector as a whole, in particular retail banks, commercial banks, will shrink dramatically as many of the services that they provide are commoditizable and will move into an automated setting. Maybe they find other things to do. We will see a thriving ecosystem of interactions between existing blockchains, of different private initiatives. All of them will be, put together with programmable money. And the financial industry in 10 years, not so much the investment banking industry or the capital markets, but the industry as banks as we know it will have changed fundamentally, will look nothing like it is today.